Welcome back. You're still tuned into Midcap Radar. It's time to focus on a corporate conversation. The stock on our radar is Embassy REIT. For Q4, company saw a stellar jump in net profit. Their revenue and margins also expanded. Company surpassed initial leasing guidance of 6 million square feet by 35%, but we did see a lower dividend payout this time. To discuss more on their Q4 performance, the CEO of Embassy REIT, Arvind Maiya, is joining us now in the studio. Arvind, good afternoon. Always a pleasure speaking with you, and we have you in the studio today, so thanks for dropping by. You have surpassed your guidance in terms of the NOI, in terms of dividend as well, but it has been lower 7% on a YOY basis. What explains that?
Sure. I think the measure to look at for us is the growth in NOI, which is important. Dividend is more one time in terms of increase in some interest cost and working capital. But what I want to highlight here is 24 was a blockbuster year. 8.1 million square feet of lease up. That's like 12 to 13% of all India leasing. That's really phenomenal. We've given a guidance for next year. We believe that our occupancy will go up from 85 to 89% on an enhanced base because we're completing 2.5 million square feet more. And we have guided to a 7% growth in distributions. That's the first year where we will be growing in distributions after our listings. All positive.
Okay, just want to bring the attention to the asset that you're planning to go ahead and acquire in Chennai. So you're looking to raise close to 3,000 crore. We believe the EV of the asset is close to 1,270. So why are you raising more than required? And why are you, going to issue units versus maybe raising debts? That's been a concern amongst a few investors.
Sure. I think two things. One, the acquisition of asset is super, I think we believe value accretive. Entering a new market, Chennai, which is doing phenomenally well. The asset is doing great, 95% leased. Even there's a building under construction which is already pre-leased. So asset is fantastic, and we believe we bought it at the right price. It's at a 6.7% discount to the average of two valuers. In terms of raising money, I think it has two components. One is to complete the acquisition, which technically we believe that we'll fund it a little bit through debt and a little bit through equity. And the balance is an enabling resolution for us because QIP can be raised at any point in time. But we as management are very clear. We will raise it at the right price. That's number one. Number two, what you also need to understand is the debt market for REITs is still evolving. The banks can't lend directly to REITs. The pension funds and EPFO cannot lend to REITs. So that's a constraint within which we're working. And lastly, we are constructing around 6 million square feet more in our existing portfolio, plus more in Chennai. We will be spending close to 5,000 crores on construction, all through debt. When you take all of this holistically, we believe it makes sense for us to raise a little bit more money in terms of equity.
Okay, all right. So it's for future expansion plans that you have that enabling resolution. Interestingly, you spoke about how you're expecting growth in FY25 as well in terms of dividend distribution. But what analysts have pointed out, and I noticed as well, it's lower than what your NOI growth is what you're expecting. Is it also because of high interest costs that you will see? What will the debt number look like in FY25?
Yeah, two things. One, we have projected to a 10% growth in NOI. And close to a 7% growth in distributions. I would say two reasons. One is, yes, there will be some impact of interest, which breaks the number down a little bit from NOI and distribution. And what happens is, while we are growing the occupancy, there's always a little bit of non-cash income which we record because of rent freeze. That comes in from next financial year onwards. That's the reason why you see a mismatch between 10 to 7. But when it all stabilizes, let's say 2-3 years later, because we're constructing so much, you will see a more even flow or even growth between NOI and distributions.
Okay, give us a sense of how your occupancy trends are, especially in the core Bangalore market. IT has seen a bit of a pullback in terms of spending. So has that affected occupancy rates over there? And also when you're talking about the enhanced distribution base that we will see, or the enhanced equity base we will see in FY24, would that impact DPUs?
Yeah. In terms of occupancy, firstly, IT impacted us in the last couple of years, but all of that was taken up by global captives. I think you've said that enough number of times, I don't want to repeat it. But what's happened is the portfolio occupancy has kind of stabilized at 85%, and we have guided to a higher number, as I said, of 89. But our two core markets, Bangalore and Mumbai. Bangalore, we are at 91% occupancy. Mumbai, we are at 99% occupancy. We're constructing 6 million square feet in Bangalore only over the next 3 years. The next 2 years deliveries is 4.7 million square feet. 80% is already pre-leased, all by captives. And we did around 5 deals last year, more than 300,000 square feet, which means there is a return of big deals. So that's on the occupancy bit. In terms of, sorry, I missed the second part of the question.
What will be the DPU guidance that you give?
Yeah. So DPU guidance is a 7% growth. And as we have mentioned in our acquisition materials, both the acquisition of Chennai as well as the fundraise is expected to be accretive to distribution. So distributions will grow because of this and not reduce.
Okay. You also spoke about how occupancies will increase. How much of it will come from the new SEZ notification? How much of occupancy is driven by that in Q4, and what will outlook for FY25 be?
Yeah, I think Q4, not much, because we finally got the guidance from Ministry of Commerce on how to pay back duties. So that impact you will see in the coming year. A large part of our vacancy is in SEZ is in Bangalore, of course. So I believe that will all get taken up in the year to come, or max 2 years. And we have factored that in the growth in occupancy for our FY25 guidance.
And has it impacted rentals as well? Are you seeing an increase because of now this SEZ occupancy also being taken up?
To be frank, Sonal, the rentals has always been stable.
Okay.
It's about, if there's a grade A space like ours, they're ready to pay a premium. Actually, the 3 assets which we own in Bangalore, I would say arguably the best in India. And we are able to lease it at 5 to 8% premium to market rents. Okay. So people don't mind paying rents as long as it's the best space.
Okay, give us a sense of the leasing pipeline now. What are the kind of investments you're expecting here, and what kind of growth can you see maybe next couple of years?
I think leasing pipeline, as we've, I'll restrict it to what we have disclosed publicly. We have a pipeline of around 1.8 million square feet at the year end. That will just get converted, let's say, in the next couple of quarters. But big picture, it's all about global captives. They're the guys taking up space. I think IT will take a little bit more time for it to come back to market. So we're very keen. Last stat I'll leave with for investors when we talk about global captives. 72% of the global 500 companies don't have a GCC in India. And I believe they are the guys who will come further to India and grow in India. So that's going to be a target market.
Okay, so this is about the commercial space. You do have a hotel segment as well. What will that look like as a percentage of NOI, say 2 to 3 years down the line? Will you invest more there?
Yeah. So today we have 3 operating hotels. We did around 56% occupancy. 14% growth in ADR, and our EBITDA doubled from 90 to 180 crores. We are constructing 2 more hotels in Embassy Tech Village. So largely our philosophy is to own hotels in our business parks. We call it the total business ecosystem. So as we speak now, that's what is there in the pipeline. And we believe hotels will be less than 10% of our overall NOI.
Okay.
Thank you so much for your time, Arvind here. Pleasure, and very good to have you in the studio. We'll now slip into a short break. We'll discuss a few stocks, especially some of the result reactions when we come back.